Okay, welcome to our evening lesson. And in this particular lesson, we want to talk about legitimate tax deductions. We had an agreement that in this particular lesson, we will look at actually this particular topic. First of all, we need to understand what do we mean by this particular sentence, legitimate tax deductions. Legitimate tax deductions basically refers to those pre-tax deductions that are made on the gross income or that are made on the taxable income before we effect the taxes. This refers to those pre-tax deductions, made on the taxable income some adjustments. We can call them adjustments made on the taxable income before taxation is effected. Before taxations is effected. Legitimate tax deductions. These legitimate tax deductions, they have a certain effect on the taxable income and consequently the income tax payable. They, and when I talk about they, I'm referring to the legitimate they reduce the taxable income. They actually reduce the taxable income, and when the taxable income reduces, that means the income tax payable also reduces. They reduce the taxable income and the resultant income tax payable. The resultant income tax payable. So we have two things that reduces. These are the taxable income and the income tax payable, because the income tax payable emerges from the taxable income. So when that amount is small, it means also the taxation also, or the band that will be used in taxation will be different, and it can lead to a reduction in taxes. What are some of the examples of legitimate tax deductions? Examples of legitimate tax deductions. We have talked about them in our previous two lessons, and we say that examples of these pre-tax deductions, they are like donations. These donations are made to to charitable organizations. And how do we call them legitimate? Because some people might claim that they have made some donations, and when you try to find out where the donations were given or where they went to, or the cause the donations are supposed to support, they are not there. They cannot be found. So how do we call that these donations are legitimate while others are not legitimate? These donations should be to registered charitable organizations. These donations should be towards registered charitable organizations and should also be supported by receipts and invoices. The second example of legitimate tax deductions or pre-tax deductions, this can be towards the funds that were spent towards work-related expenses. And for them also to be legit, we need to have should be supported, should be or ought to be supported by receipts and invoices. Without those two documents, the legitimacy of the pre-tax deductions will not be there. So, having defined legitimate tax deductions and having stated the reason to why we call them legit and the documents that should prove that, let us now move on and look at how do these pre-tax deductions affect the taxable income and the income tax payable. And our first example is about somebody called Charles. Charles is a medical doctor because we also have academic doctors, and his taxable income is $80,000. Our first question is, what is his tax payable amount? What is his tax payable? We can also call it income tax payable. We need to find out. When you look at this taxable income, 80,000, it falls within the middle tax bracket. $80,000 or lies between the middle tax bracket, or what we call the third, the middle tax bracket. And in this particular bracket, we need to find out how is taxation carried out in this particular bracket. That is to say, he ought to pay a sum of $35.72, that is $3,572, plus an additional of 32.50 cents for each dollar over and above $37. This is the rule that guides taxation in the middle tax bracket or the third tax bracket. So his tax payable will be based on that. His tax payable will be $35.72 plus 32.5. This is cents. We can write it as a fraction like that. For every dollar above 37,000, but he earns 80,000. Just like in the previous examples, we'll find the difference between his taxable income and this particular ceiling we are given here. Our taxable income is $80,000. Then we subtract the ceiling that we are given, that above that particular amount, $37,000, every dollar will attract 32.5 cents in taxes. So this will give us this will be 35.72 plus this particular operation. This will be 32.5 out of 100 multiplied by the difference here. When you subtract, you'll get 43,000. So in this 43,000, every dollar will attract 32.5 cents. So we want to find how much are they going to tax this. But for the first $37,000, we have also already a tax base of 3,572. And this will actually give us 17,547. This is the tax payable. This is what Charles is supposed to pay based on his taxable income of $80,000. The second question is, that was A, this is part B. The second part, that he just found a receipt for $100 donations. He just found a receipt of $100 donation. This is a new development to a registered charity. Registered charity. Why are they talking about a registered charity? To make that donation legitimate, without which the donation will not be legit. So Roman 1 of this second question is, what will be his new taxable income? What will be his new taxable income? What will be his new taxable income? Because the previous taxable income was $80,000. With this new development, are we going to have a reduction in the taxable income? Because we said that legitimate tax deductions actually lowers the taxable income. Solution. So the new taxable income will be equal to is old the initial taxable income minus the donation, which is actually a deduction, minus the donation, and this will be $80,000 minus $100, and this will give us $79,900. This is the new taxable income. And as you can see in this particular example, this donation, which is a deduction, has actually reduced the taxable income, as we have just learned in our initial development of this particular lesson. Let us look at the second bit. By how much does the donation decrease his tax payable? By how much? Does the donation decrease or reduce his tax payable? We need to find out, with this new taxable income, how much will be the tax. What we ought to understand is that this particular new taxable income still falls within the third or the middle tax bracket. So his tax payable in the third tax bracket will be equal to $3,572 plus 32.5 cents for every dollar that he will make above $37,000. So we need to find the difference between $79,900 and $37,000, which is the ceiling in the middle tax bracket. So the new tax payable will be equal to $17,514.50. This will be the new tax payable based on the new taxable income of $79,900. So we need to know by how much does the donation of $100 reduce his income tax payable. So the reduction on income tax payable, this is going to be the difference between his initial tax payable that is before the donation, and this new development after the donation. Our initial tax payable was $17,547, and the new one is 17,514.50, and this particular difference is actually $32.50. $32.50. This basically means the $100 donation reduced his income tax payable by $32.50, and we have already seen to which level did it reduce his taxable income. It reduced from $80,000 to $79,900. Let us look at another example, another interesting example. We are still on legitimate tax deductions. We have another person called Lee. Lee is a website developer. On June 30th, that is the end of a financial year, she made the following notes. She made the following notes. About the financial year. She made the following notes about the financial year. And the notes were as follows. Hapo itaonekana. Imefika. Hapo. That her gross income from the employer amounted to $58,725, and her gross income from casual job amounted to $7,500. Her interests on investment the interests were $75, her donations in that particular financial year, her donations were $250. Her work-related expenses amounted to $425. And lastly, the tax paid during that financial year, amounted to $13,070. $13,070. These are the notes she made concerning her expenses, her income, donations, work-related expenses, and ultimately the taxes that she had paid during that particular financial year. Our first question is for us to calculate least taxable income. We calculate her taxable income. And as we have learned, even in the previous examples, that this taxable income is usually equal to total donations, total gross income minus the total donations. Total deductions, not donations, total deductions. And our total gross income must be identified. What contributes to that? We have a gross income from the employer, another gross income from the casual job, and we also have interests on investment. All those contribute to her total gross income. This will be the sum of 58,725 plus 7,500 plus $75, and this will give us a total of $66,300. And our total, this is what we have been looking. This is just but part of this particular entire equation. And our total deductions will be from these two, the donations and the work-related expenses, and this will be 250. It should be $250 plus $425, giving us $675. Total deductions amounts to that. So what will be her taxable income? Her taxable income will be the difference between $66,300 and $675, and this will give us $65,625. This will be least taxable income. The question was for us to calculate her taxable income, and this will be the taxable income. Let us look at another question related to this. B, we are supposed to use the earlier We use the earlier tax table. We use the earlier tax table to calculate least tax payable amount. How much will it be? How much will it be? So when you look at her taxable income of 65,625, it actually falls within the middle tax bracket. And if it falls within the middle tax bracket, we have already used that particular tax bracket in our first example. The rule in that particular tax bracket is that we have a base tax of 35.72 plus an addition of 32.5 cents for every cent above $37,000. And if for every dollar that she will earn above $37,000, it will attract 32.5 cents in taxes, and her taxable income is to the tune of 65,625. So we need to find the difference between the taxable income and that ceiling that has been provided in that particular tax bracket. So this will be 65,625 minus 37,000. And this will give us 35.72 plus 32.5 cents multiplied by the difference will give us, the difference will be 28,625. 28,625. That is the difference between the taxable income and the ceiling provided in that particular bracket. So we carry out the multiplication of this, and then we can add on this. And if we do that, we are going to have 35.72 plus 9,303.13 dollars, giving us a total of $12,875.13. This is what she is supposed to pay in taxes. Let us look at the next question relating to the same. And this question gives us more information that Lee must also pay the Medicare levy of 1.5%. Lee must also pay the Medicare levy of 1.5% of her taxable income. Her taxable income. How much is the Medicare levy? How much is the Medicare levy? How much is the Medicare levy? We have dealt with similar questions before, where we said that the Medicare levy is equal to 1.5% of her taxable income, and in this case her taxable income is $65,625. So this will be 1.5 out of 100. We express that as a fraction, and of means multiplication. And this will give us a Medicare levy of $984.38. This is the amount the ATO, Australian Tax Office, will deduct from her income and remit to the federal government of Australia to manage the health care system. Our next question. So apart from the tax payable that we have calculated, the Medicare levy is another form of tax. But this particular tax is not calculated from the tax table. This is just calculated from the percentage that we are given, 1.5% of the taxable income. Of the taxable income. The last part of this particular question requires us to add the tax payable and the Medicare levy. And the Medicare levy, we add them to get the total money that will be paid in form of taxes. The total this total will be the tax payable, which is 12,875.13 plus the Medicare levy, which is 984.38, and this will give us 13,859.51. This is the total amount she will pay in form of taxes. And how can this particular amount that we have just calculated be of any help to her? This amount will help her to know the net tax that she's supposed to receive. So based on this particular amount, let us look at the next question. What is her net income? What is her net income? What is her net income? We have learned that for us to get the net income, we take the gross income, the total gross income, minus the total deductions. The total gross income minus the total deductions. And what was her total gross income? Her total gross income was 66,000. If you remember from part A of this particular question, $66,300. And the total deductions, that we have obtained should include the total taxes and also the donations that she is going to make. So this will be equal to the difference between 66,300 and 859.51. How much is that? And this will give us 52,444. 440.49 dollars. And the last bit of this particular question, not necessarily the last, let us look at the next one, which is part F. Express the total tax in part the total tax in part D above express the total tax in part D above as a percentage. As a percentage of least taxable income. Least taxable income to 1 decimal place. To 1 decimal place. It brings in the issue of decimal places. We need to express the total taxes that we have just calculated. And this, we need to identify the total taxes. Total tax. Our total tax was $13,859.51. And the taxable income. And the taxable income, least taxable income was $65,625. With these two figures, we are set to go. We are set to calculate, to express this particular figure as a percentage of this second figure. Actually, that is what this particular question requires us to do. This is what this particular question requires us to do. We express the total taxes as a percentage of the taxable income. And this basically means we have the total tax. For us to express it as a percentage, we need to take this all over the taxable income. Over the taxable income. And this particular ratio should be multiplied by 100%. So that the same can be converted to a percentage. Remember, when we are converting a certain figure to percentage, we simply multiply by 100. And when we multiply by 100, we will have expressed that particular figure as a percentage. How much is this one going to be? This will be 13,859.51 out of a total of $65,625, and you multiply the same by 100%. We have been told to express this particular total tax as a percentage of the total income, taxable income, not just income, but taxable income. And this will give us 13,859.51. When we divide that by 65,625, we get 0.21119,253, and then we multiply the same by 100%. This is just expressing this fraction as a decimal, and this will give us 21.9 1. When we multiply by 100, we basically move the decimal point 2 places to the right. So this is 1, 2. This is 21.119%. But remember, the question required us to write our answer in one decimal place. So this will be 21.1%. We round it off to one decimal place. What does this particular percentage mean? What does it mean? We can go ahead a step further and ask ourselves a question: what does this particular percentage mean? This percentage basically means that for every dollar she earns, 21.1 cents goes to taxes. Bado dakika ngapi? 21.1 cents, or 21% of every dollar, which is actually 21.1 cents, goes to taxes. And our very last question, last part of this particular question is, has Lee paid too much tax or not enough? This is part G. Has Lee paid too much tax or not enough? Or not enough? When we are answering that question, then we'll be looking at two things. If she has paid too much, then we calculate her tax refund. And if she has not paid enough, we calculate her tax liability. I hope you know what those two terms means. When we are looking at this, we need to know how much has she paid. Actually, we are told tax paid during the financial year was just $13,070. And do we know how much she was supposed to pay? Yes, we have calculated that. So we look at tax paid during the year. The financial year is just $13,070. But the actual tax that was supposed to be paid, the actual tax that was supposed to be paid we have calculated it, and it was $13,859.51. That is what she was supposed to pay, but she has only paid this. When you compare those two figures, you'll discover that she has paid less. And if she has paid less, she will receive a letter from the Australian Tax Office demanding for a tax liability. So first thing, we have agreed that she has not paid enough. If she has not paid enough, then we have tax liability. This tax liability will be the difference between the two figures. She will have to pay a tax liability of her tax liability will amount to 789.51. She's supposed to pay this. This is her tax liability. That is her tax liability. So having looked at how to calculate how to assess the legitimacy of deductions and how the deductions can affect the taxable income, we said that legitimate tax deductions reduces the amount of taxable income, and as a result, that also affects the amount of tax that someone pays. It lowers the amount of tax you pay. But before you claim the legitimate tax deductions, you need to have the documents supporting your claim. Those are the receipts and the invoices. If they are donations, let your donations be to a registered charitable organization. And if they are work-related expenses, you should also have the receipts and also the invoices. That will give your deductions claims legitimacy. You need to look at that. And we have also, one more time in this particular lesson, looked at these two terms, tax refund and tax liability. Just a reminder that if one has paid too much tax, the person will claim a tax refund from the Australian Tax Office. In fact, the moment you fill your tax returns, the Australian Tax Office, the systems will detect that you have paid too much tax, and a tax refund of the extra amount will be remitted back to your account. And if it happens that you have paid less, like in the case of Lee, she was supposed to pay $13,859.51, but she only paid $13,007. This is not her fault, because the tax payment or tax remittance is done by the employer, as we had already looked at. So this mistake was committed by the employer, but sometimes can be due to fluctuations in the taxation table that we have in the ATO website. So if one happens to pay less, as the case in Lee here, she will have to pay what we call a tax liability, an amount to fill that particular gap that was remaining. So that is what we have. I hope you have enjoyed our lesson today, and I want to invite you to my next lesson, where I'll be looking at another concept, but still in financial mathematics. Thank you so much and welcome.